Hello everyone and welcome back to the sessions on Advanced Strategic Financial Management. Now friends, in this class, in continuation of the topic Advanced Capital Budgeting Part 2, we are going to talk about real options. Within capital budgeting, when we have seen the decision tree and the decision tree analysis, we have seen possibilities of dependent and independent cash flows. We have also talked about conditional probabilities. Blending all these concepts, now in this class, let us try to understand what could be real options in the context of capital budgeting decisions. And for this purpose, what I'll do is, I'll directly take your attention to a very good question asked in past exams. In our book, it is classified as question number 29. Let us first read this question. You own an unused gold mine that will cost rupees 10 lakhs to reopen. If you open the mine, you expect to be able to extract 1000 ounces of gold a year for each of 3 years. After that, the deposit will be exhausted. The gold price is currently rupees 5000 an ounce, and each year the price is equally likely to rise or fall by rupees 500 from its level at the start of the year. The extraction cost is rupees 4600 an ounce and the discount rate is 10% required. Should you reopen the mine now or delay 1 year in the hope of a rise in the gold price? What difference would it make to your decision if you could costlessly but irreversibly shut down the mine at any stage? Show the value of abandonment option. Now friends, what you need to do in this particular case, all the questions of conditional probabilities that we have dealt with, the probabilities were given with respect to where you are drilling for extraction of oil. So probabilities were associated with whether you will find oil or you will not find oil. If you are giving exam, whether you will pass or you will not pass. Here, with this gold mine question, the probabilities are not associated with whether you will find gold or not find gold. The probabilities are associated with the price of the gold. So one thing what is certain in this example is, if you start extracting the gold, you will find gold for next 3 years, and after that the gold deposits will be exhausted. And during these 3 years, the quantity of gold that you can extract is 1000 ounces every year. Now, currently the price of the gold is rupees 5000 per ounce and the extraction cost is rupees 4600 per ounce. So currently it will give you a profit of 5000 minus 4600, that is rupees 400 per ounce at the current price level. But what is the risk involved in this decision is, the price may not remain stable. The price can change at end of each year. It is equally likely that the price may rise or fall by rupees 500. So what is 5000 now can become either 5500 or 4500 in 1 year time. Then from each of those two nodes, the price can further rise or fall because the probabilities are for independent situations. That means what has happened in the previous year, independent of that, again on a fresh basis from any point, from any node in your decision tree diagram, the price may rise or fall. So what we do is, we first of all plot not a decision tree diagram over here, but a tree of outcome, where outcome indicates the expected price of the gold at end of each year, and let us look into how many alternative paths we can get. So in your solution, the first thing that you should do, you make a working probable price of gold over a period of 3 years from now, starting from rupees 5,000 per ounce. So rupees 5,000 is the price prevailing now. It is equally likely to happen that the price may either rise or fall by 500. So if it rises by 500, what is 5,000 now will become 5,500 in 1 year time, or if it falls, it reduces to 4,500 by end of the first year. Now these two are the nodes that represents the two possible outcomes by end of first year. Thereafter, what can happen? From each of these nodes, there will be a further possibility of rise and fall in price, where the probabilities of rise and fall will be same, that is 0.5. So I am just plotting the probability and the resulting price. So it will be with 0.5 probability that the price can turn 6,000, and with a 0.5 probability that the price can turn 5,000, where these will be the outcomes by end of second year if the outcome in the first year was 5,500. Likewise, from this 4,500 node as well, there may be chance of rise in price by 500 or fall in price by 500. So now we have these four outcomes by end of second year. So guys, if you would want to find the probabilities of these four outcomes, in other words, the joint probabilities of these four outcomes, this 6,000 will happen when the first year has resulted into a rise in price, and again in the second year there was a rise in price. Probabilities for rise in price for each year was 0.5. So the joint probability that the price would come to 6,000 will be 0.5 into 0.5. That would give you 0.25 as the joint probability of this outcome, where the price becomes 6,000. Likewise, the joint probability of each of these four outcomes will be 0.25 each. But this is not the end. This is just the end of second year. From the end of second year, again there can be equally likely chances of rise in price or fall in price by rupees 500 from where we started at end of the second year. By end of third year, you will find that there can be 8 possible outcomes. Now, because there can be 8 possible outcomes, if you want to find the joint probabilities of each of these outcomes, how will you reach 6,500? It will be rise, rise and rise. So that is 0.5 into 0.5 into 0.5. It will give you the joint probability of 0.125. If you come to this particular outcome, it will be rise, rise and then fall. So the probabilities will be still 0.5 into 0.5 into 0.5. So it will be 0.125. So joint probabilities of each outcome in that case would come to 0.125. So please carefully take note of this tree of outcome, and then I take you ahead. Alright friends, I am sure you have completed writing this entire tree of outcome. Now at end of each year, that is year 1, year 2 and year 3, if I would want to find the expected price of gold, you know, in year 2 there can be 2 possible outcomes which are equally probable. So 0.5, 0.5 is the probability of these 2 outcomes. At end of year 2 there can be 4 possible outcomes which are equally probable. That means the probabilities of each of these could be 0.25, and by end of third year there will be 8 possible outcomes which are equally probable. That is why the joint probabilities that we have plotted over here, it is 0.125. So the respective price would get multiplied to the respective probability or joint probability, as the case may be, to arrive at the expected price of the gold by end of each year. So let us look into that particular working. So expected price at each year based on the probabilities given. Year 1 it will be 5,000, year 2 it will still be 5,000, year 3 it will still be 5,000. So please write up this calculation and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead, and now in the next working we compute the cash flow for each year. So expected annual cash flow for each of the 3 years. As the expected price of gold is rupees 5,000 per ounce in each of the 3 years, the annual cash flow in the 3 years will be constant, correct? Price per ounce is 5,000, extraction cost per ounce is 4,600, profit per ounce will be 400, and multiplying this to the quantity in ounce, you will be getting the annual cash flow of rupees 4 lakhs for each of the 3 years. So please write up this working and then I take you ahead. Alright friends, once you have completed this working, let us compute the NPV if the mine is reopened now. So it will be expected NPV if the mine is reopened now. PV of annuity for 3 years at 10% per annum is 2.486852. Because the cash flows are uniform, you can apply the annuity factor. Now the present value of inflow comes to 9,94,741, but to reopen the mine, the initial investment will be 10 lakhs. In other words, the present value of outflow is 10 lakhs. So the expected NPV is coming to a negative amount of 5,259. So please write up this calculation and then I take you ahead. Alright friends, I am sure you have completed writing this calculation. Now unfortunately we are getting a negative NPV if we are reopening the mine right away. Now what is another alternative given in the question? In fact, while reading the question, we did not understand the true sense of that alternative, that what would happen if you wait for 1 year and reopen the mine only if the price rises. So here it makes a complete sense, because if you reopen the mine now, the outcome is turning into a negative NPV because the extraction cost and the price of gold, that difference is just rupees 400 per ounce, which is not sufficient to bring a positive NPV to you. Instead, if we wait for 1 year and let the price rise, see, at 1 year end the price may even fall. If the price falls, at the current price level itself, it is giving a negative NPV. If the price falls, definitely it will be a negative NPV. Then we don't even think of opening the mine. But what if we wait for 1 year and in anticipation of rise in price, and what if the price actually rises to 5,500, the base price will become 5,500. So instead of opening the mine right away, if you wait for 1 year, and if the price rises and then you reopen the mine, the base price will become 5,500. From there, it will be equally likely chance of rise or fall in price by rupees 500. And therefore, the expected price of gold itself on basis of probabilities given to you, it will come to 5,500. So if the price is 5,500 and extraction cost is 4,600, the profit per ounce will be rupees 900 and the cash flows will be rupees 9 lakhs, correct, for each year. Then it will be highly profitable to reopen the mine after 1 year and not now. But let us actually observe the outcome of this, and what you do is you make this heading over here very clear as probable price of gold over a period of 3 years after 1 year from now, starting from 5,500 per ounce. Now guys, understand one thing, this 5,500 is based on the assumption that the price has risen up. The probability of that is 0.5. The other possibility was the price might have declined. In that case, this will not arise. So we will keep in mind that this whole calculation is based on a 50% chance. Anyway, so after 1 year, if the price rises to 5,500, then when you start, you get the starting point of price of gold as 5,500. Then you can have rise and fall with equal likelihood, and the tree of outcome would present 4 outcomes by end of second year, and then of course 8 outcomes by end of third year. All these outcomes are equally likely, and therefore the joint probabilities of these 8 outcomes by end of third year will be 0.125 each. Keep in mind one thing, what we are calling as third year is actually 4 years from now. Why? Because this starting point is not now. The starting point will happen after 1 year from now. So keep in mind one thing, everywhere when we are writing heading as well, we are writing after 1 year from now. So please write up this tree of outcome and then I take you ahead. Alright friends, once you have noted this tree of outcome, let us move ahead and compute the expected price at end of each year based on the probabilities, and you know how you will have to work out. This will give you price of 5,500 as expected price each year. So quickly take note of this working and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead, and now what we calculate is the expected annual cash flow. So if the price becomes 5,500, the price per ounce as the expected price minus the extraction cost per ounce will give you profit per ounce as 900, and multiplying to the quantity you get the annual cash flow as rupees 9 lakhs per annum for 3 years. So please write up this working and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead, and now what we do is we compute the NPV if the mine is reopened after 1 year from now. So annuity factor for 3 years is known already. To that you multiply your annual cash inflow, and from that you subtract the present value of outflows. NPV, that will be NPV after 1 year from now, it is 12,38,167. First write up this calculation and then I'll provide the required explanation. Alright friends, I'm sure you have completed writing this calculation of expected NPV that will arise after 1 year from now. So please understand one thing, this is not your NPV at today's terms. This is an NPV that will arise after 1 year, because what is happening, the extraction period is 3 years and waiting period is 1 year. So originally if we were reopening the mine immediately right now, then the NPV that arises is the NPV at present, which was a negative NPV we already worked out. If we wait for 1 year and if the price rises and then we reopen the mine, then you get this resulting NPV, but that is not an NPV in today's terms, it is NPV after 1 year. That too only when the price rises. Now can we agree that the price may even fall? So when you are at the current time, that is 0 year, you wait for 1 year. After 1 year, if the price rises, the resulting NPV is there in front of you. If the price falls, you are not going to reopen the mine, then the resulting NPV will be 0. So the probability of NPV being this amount or 0 is equally likely, means 0.5 each. So 0.5 multiplied by this NPV plus 0.5 multiplied by 0 NPV, that would give you the expected NPV after 1 year, because there can be two possibilities, the price may rise, the price may fall, with equal probabilities as 0.5 each. Then you get the expected NPV after 1 year, discount it further by 1 year, and then you will be getting the expected NPV in today's terms. So let us do one thing, whatever I have just explained, let me give you that thing in a clear note. So please write as a note, the above determined NPV is not the NPV at present, it is the probable NPV after 1 year from now, which will arise only when the price of the gold rises to 5,500, the probability of which is 0.5. After 1 year, if the gold price falls, it will be advisable not to reopen the mine. In such case, NPV equals to 0. expected NPV after 1 year will be 12,38,167, which we just obtained from the previous working, multiplied by probability of rise in price, that is 0.5, plus 0 NPV if you do not reopen the mine in the event where the price falls, multiplied by its probability of 0.5. This would give you expected NPV, but still not in today's terms. It will be expected NPV after 1 year. This comes to 6,19,083. So please write up this entire note and then I take you ahead. Alright friends, once you have completed writing this note, let us move ahead, and now we conclude one thing, that the expected NPV in today's terms, when the gold price rises to 5,500 after 1 year, that is if the mine is reopened after 1 year, it will be the expected NPV that you were getting after 1 year, further discounted by 1 year, that is dividing by 1.1. You get the resulting NPV in today's terms as 5,62,803. So the conclusion that you need to write is, it is better to reopen the mine after 1 year when the price rises. It is advisable not to reopen the mine now. So please write up this conclusion and then I take you ahead. Alright friends, once you have completed writing this conclusion, now let me put light on what exactly is required further. Question has given you basically two requirements. The first requirement was you to make a choice. Should you reopen the mine now or should you reopen the mine after 1 year? So that part you have concluded that it is better to reopen the mine after 1 year. Reopening the mine right now is certainly not the right choice. That part done. Second part in the question is talking about abandonment option. What if the company has an option to abandon the mine at any point costlessly, means without incurring any cost, but irreversibly, means once you abandon, then you cannot extract gold out of that. So what would happen if that abandonment option is available, and what will be the value of that abandonment option? The value of that abandonment option is basically termed as finding the value of a real option. So unlike the options in derivatives, this is not a derivative instrument, this is not a financial option, this is basically a real option. So you have an abandonment option, what would be the worth of that? So what we do is we first write a heading as evaluation of abandonment option. And again, we will be evaluating the abandonment option for both the scenarios. That is, what if the mine is reopened now and what if the mine is reopened after 1 year? In either case, what will be the worth of this abandonment option? So, you know what we have to do? We have to first look back to the tree of outcome where multiple possible prices have been arising as an outcome of different events. And when you focus on that, you get to know what exactly will be the abandonment option and how it will be worked out. First, I'm sure you would have written this heading, evaluation of abandonment option. So now this diagram you have already drawn, you don't have to write up this again. This is basically the probable price of gold over a period of 3 years from now, starting from rupees 5,000 per ounce. You have already made this as the first initial presentation. Now you know what happens when you are at this stage. You are thinking of reopening the mine because you can have both the possible outcomes, either the rise in price or fall in price. If the price rises, definitely it is a beneficial outcome. If the price falls and it comes to this, it may still be beneficial from this point. Why? Because from this point there is a possibility of price rising and then again price rising. Can you understand one thing? That in the first year the price of the gold was say 4,500. In the second year, suppose it becomes 5,000, and then again suppose it becomes 5,500, it might be a profitable option. So you cannot afford to shut down the mine at this stage. However, imagine when you are at the end of second year, you can have any of these four alternative outcomes. Either the price at that time is 6,000, which indicates highly beneficial scenario ahead. So no reason for shutting down or putting your mine as abandoned. If it is 5,000 in these two nodes, still it could be beneficial ahead. However, if the price of the gold by end of second year is 4,000, one thing is very clear, that the price at end of third year, even with the best case scenario, would now go to only 4,500, where the extraction cost is just more than that. It is 4,600 per ounce. That means even with the best case scenario, you are going to incur a loss. That means when your gold price is just 4,000 per ounce by end of second year, it is definitely giving you an indication that it is a case of a total loss ahead, and that is the point where you need to stop. So if at all abandonment option is to be exercised, it will be exercised at end of the second year when the gold price is 4,000 per ounce. So let us write that point over here. So you have already written the heading evaluation of abandonment option. Now under this heading you write, if the mine is reopened now, it is advisable to shut down mine at end of second year if the gold price falls down to rupees 4,000 per ounce, because from that point there is certainty of loss in the third year. Now we have revised calculation of annual cash flows. You know what will happen? Year 1 and year 2 annual cash flow will continue to remain same as earlier, that will be rupees 4 lakhs. However, from year 3 the cash flow computation will be little different. Let me explain this point to you. This is something very important. Carefully pay attention. See, I am not considering the price of the gold now. I am in fact considering the profit part per ounce and then multiplying that to respective probability. So if you are wondering from where did I get this 1900, from where did I get this 900, this 900, this minus 100, for that purpose let me give one additional explanation and allow me to take you back to that tree of outcome. Look at this, guys. This is the best scenario in the third year where the price of the gold reaches 6,500. You know, the extraction cost is 4,600. So what will be the revenue per ounce? 6,500. The cost of extraction per ounce is 4,600. So what will be the profit per ounce? 6,500 minus 4,600. Correct? That will be 1,900 per ounce. If the price is 5,500, it will give you a profit of 5,500 minus 4,600, that is 900 per ounce. Again 900 per ounce profit over here. But if the price is 4,500 and the extraction cost is 4,600, it will be a loss of rupees 100 per ounce. Again 5,500 over here will give you profit of 900 per ounce, and price of 4,500 will give you loss of 100 per ounce. These two, however, will not arise because we have decided at end of second year itself that if the price is 4,000 over here, we are going ahead with the abandonment option. We will not continue with the extraction. If we are not continuing with the extraction, these two possibilities will not emerge at all. Now what would happen? We are going ahead and we are finding that in the third year, look at this, 1,900 was difference between 6,500 and 4,600. Then 900 was difference between 5,500 and 4,600. Same thing. This minus 100 came as 4,500 minus 4,600, and each profit figure, if I am multiplying to its respective probability of 0.125, I will be getting the expected profit per ounce multiplied by 1000 ounces. You know, the effective cash flow for the third year with abandonment option does not remain 4 lakhs like earlier, it becomes 5,50,000, giving you a possibility of a positive NPV over here because the cash flow in the third year has substantially increased. So please write up this note and these calculations and then I take you ahead. Alright friends, once you have written this whole thing along with this calculation of cash flows, time for us to move ahead and compute the NPV of abandonment option. That is NPV along with the abandonment option if the mine is reopened now. So it is very simple task. Once you have identified the annual cash inflows with the abandonment option, just convert these cash inflows to their respective present values. You get the PV of inflow minus the PV of outflow and you find that the net present value turns to be a positive amount over here. That means along with abandonment option, the whole project becomes beneficial. The NPV turns to be positive. So before I conclude anything further, please write up this working quickly. Alright friends, once you have completed writing this working about net present value that you have obtained along with abandonment option under this possibility that if the mine is reopened now. Now please compare what was the NPV without this abandonment option. If you reopen the mine now, the NPV was a negative NPV. It was 5,259 negative. But with the abandonment option, it is becoming this much. So from negative 5,259 to positive amount like this, whatever is the increase in NPV, that is actually the worth of the abandonment option if you are thinking of opening the mine now. So let us write that important point over here. What you write? We have to evaluate the abandonment option under scenario where the mine is reopened now. Don't forget that we have two possible scenarios. One is to reopen the mine now and one is to wait for 1 year and then reopen after 1 year. In this case, we will say it is observed that with the availability of abandonment option, the NPV increases from negative 5,259 to positive 1,07,438. So NPV increases by 1,12,697, this amount, correct? And we can say, therefore, the value of abandonment option is 1,12,697 if the mine is reopened now. So please write up this entire conclusion and then we will once again calculate the value of abandonment option if the mine is reopened after 1 year. But before I do that, write up this part of the conclusion quickly. Alright friends, once you have written this concluding part, we have one more thing to answer, that will be evaluation of abandonment option if the mine is reopened not now but after 1 year from now. So first of all, write up this heading quickly. Now under this heading, you don't have to make this tree diagram once again because you have already written this. What I want you to understand is, again, the loss making part, the only loss making part could be this part, correct? When the price of gold at end of second year comes down to 4,500, because if you continue, what may happen? 0.5 probability of price becoming 5,000, 0.5 probability of price becoming 4,000. The average price based on these probabilities or the expected price would be 5,000 into 0.5 plus 4,000 into 0.5, that comes to 4,500, but the extraction cost is 4,600. So it is assured that this part could be considered for abandonment. That means at the end of third year, these two outcomes can be avoided. So with this thing in your mind, you just write if the mine is reopened after 1 year from now with expectation of rise in price, it is advisable to shut down the mine at the end of second year if the gold price falls down to rupees 4,500 per ounce, because from that point there is a certainty of loss in the third year. So revised calculation of annual cash flows. So as we have dealt with in the earlier part, the cash flows of year 1 and 2 will remain same. In this scenario, the cash flows in the first and second year will be 9 lakhs per annum. How we got this 9 lakhs per annum? We have already shown the workings earlier. And for year 3, the cash flow will be rupees 9,25,000. So just a little increase in the cash flow because of abandonment option. Mind it, abandonment option has a greater value in the earlier case compared to this one, because here there is a slight improvement in your cash flow calculation. So quickly write up this entire note and then I take you ahead. Alright friends, once you have completed writing this note, let us move ahead. And now what we do is we compute the NPV along with the abandonment option if the mine is reopened after 1 year from now. So do you notice that the cash flow that we have now considered will be 9,25,000 for the third year, other things remaining same. You apply the same PV factors and now what you get is the PV of inflow as 22,56,949, subtracting 10 lakhs from that, you will be getting the NPV as 12,56,949. In fact, when we compare this with the NPV that we got earlier without abandonment option and NPV that we are getting now with abandonment option, of course this is little higher, but this is just a little higher. That means there will be no significant difference between the NPV without abandonment option and with abandonment option if you are deciding to reopen the mine after 1 year from now. Anyway, write up this calculation quickly and then I take you ahead. Alright friends, once you have completed writing this entire working, let us move ahead and we would say the expected NPV after 1 year will be the NPV that you obtained with a probability of 0.5, because this is going to happen only if the price rises after 1 year. If the price falls, we will not reopen the mine at all, and in that case it is 0 NPV multiplied by 0.5. So the expected NPV after 1 year will be 6,28,475. If you want to find the NPV in today's terms, you bring it down to the present value, and that will be 6,28,475 divided by 1.1, and that comes to 5,71,340. Now, whatever final amount of NPV in today's terms you got without abandonment option, if you subtract it from this NPV, you get the value of abandonment option, and that would be 8538. So look at one thing, for the option to reopen the mine now, abandonment option is substantially worthwhile. Here also it is worthwhile, but it is not making much of a difference. So please write up this entire calculation and that will be end of the solution.